Hi, this is Anil. I was fortunate to be the All India Rank 1 holder in RBI exam back in 2018. Now, I'm absolutely thrilled to be part of Oliveboard as a super mentor for their RBI Grade B programs. If you are aspiring to crack this exam in 2024, I will be available as a super mentor to discuss one-on-one with you, share strategy lessons, draw lessons from my preparation and set you up for success. Click the link below to check out the details. See you on Oliveboard soon.
I remember in our childhood days when we used to study SST, teacher used to tell us about the barter system. How in the ancient times the transactions and the trade used to happen. There was no concept of money, and because of that, if I have food and the other guy has clothes, I can trade my food with the clothes, and that's how the market usually used to operate. And that was the basic barter system. But with the evolution of currencies and with the coming of money, this whole concept of market actually evolved. But in today's session, we are not going to talk about the traditional markets, but rather in today's session, we are going to talk about the financial markets. So guys, you all must have gone through the term financial markets, but do you actually know the core deep down concept of financial market? If the answer is no, don't worry. In today's session, we'll talk about financial markets at its best, so that for your upcoming examination, you never miss a question from this particular subject. So with that note, let's start today's session, which is on financial markets. See guys, I know and I believe that many or few of your students might already have gone through this topic, but believe me, today after watching this session, you would have a very new and a very unique perspective regarding the financial markets. So without any further ado, let's see what are the contents of today's session. We'll talk about the financial market concept. Then we'll talk about the money market concept, and later, if the time permits, then we'll talk about the capital market as well, okay? So, beginning the session with the very first thing, that what is a financial market? A normal market, for example, a clothes market deals with clothes, garments. Any other food market deals with foods. But a financial market deals with financial assets. So for that, before knowing how the financial market actually works, you should also be able to understand that what are the players of financial market? Who are making this financial market? That is very important to understand. As you can see in the picture behind me, there are four major parties who are involved in the financial market. And I'll try my best to decode this, that how all these four of them play a pivot role in creating the financial market. First of all, we'll talk about the business firms. Business firms are those entities who are looking for funds. They are like blood-sucking vampires who are always in need of funds. But on the other hand, households are the innocent human beings who have those funds, who have those blood. So for that, household sector is basically a surplus sector, which is having the money, which is holding the money, and which wants to save or invest that money. On the other hand, business firms are always in need of money. But do they both interact with each other directly? The answer is no. There are some intermediaries who are involved in the interaction between the saver and between the spender. Okay, so banks and financial markets are those entities which are actually involved between these parties, so that the funds are mobilized from the savers to the spenders. As you can see in the diagram itself, business firm, they want money, so they can go to the bank. Household go to the bank to deposit their money, deposit their savings. That money can be later sent on to the business enterprises. Business can also send some money to the bank for the saving purposes as well. Similarly, the financial market plays a very similar role. Households who do not want to save their money but invest their money, they put their money into the financial market. And when the money comes to the financial market, that money can be later transferred to the business firms, and the business firms can do the same role of investing their money into the financial markets. So that's how the four players actually play their role in the financial market. This diagram is really important to understand how the financial market actually works. Now, in an economy, there are two major sectors. One is your business and the other is your household. As I told you already, businesses are the persons or the entities who want to spend money, who want money, who want sources of finances. But on the other hand, households are the entities who want to save or invest their money. And for that matter, they both are met together in a market which is known as a financial market. So households usually save a part of their earning to earn returns on it through investment. And where can they do the investment? In the financial market. And business entities will get the money from the financial market. So that's how the whole operation actually works. On the other hand, business firms always need finances for conducting businesses activities. Fine. So financial market in this term is acting as an intermediary who is trying to meet and allocate the function of matching the demand and supply of funds. All right. So I hope that makes pretty much easy for you to understand that what is a financial market, what are the players of financial market, and how does the financial market actually operates. Now, deep diving into this, let's learn about some of the major terminologies of and major functions of financial market. So basically, if the allocative function means providing the funds from the saver to the needy. So if the allocative function of the directing funds is available for investment into the most productive investment opportunity and it is performed well, then it will lead to what? Meaning, if the financial market was successful in allocating the money from the household to the business firms, then it will lead to what? It will lead to higher rate of return for the households. If the whole process, whole function was done very nicely, then the households will get the maximum rate of interest on their investment. And on the other hand, allocation of scarce resources to the firms which have the highest productivity. Those potential productive entities who could use this money to the best cause will be getting these funds. So that's how financial market is actually accomplishing two types of goals, catering two different parties to achieve their objective by performing its activities. All right. Now, coming on to the basic terms that are used in the financial market. So you will be coming across these terminologies. So before we go into the session deep down, you should be able to understand what these terminologies actually mean. First is your creation of financial asset. Creation of financial asset means you are creating a product which will be sold in these financial markets. What is that product? It can be a fresh security. It can be an equity. It can be a debenture. So, such as the initial issues of the shares and debentures by a firm for the very first time. That is creation of the financial asset. You are creating a financial product. Now, what happens when a product is already there in the market? You all must have heard about OLX. What happens in OLX? Do you sell recently or freshly made products in I forgot the name itself, okay? OLX, yeah. No, the answer is no. In OLX, you sell those products which are already in the market. Similarly, in the financial market also, if the securities are already running in the market, some person has already purchased those securities and want to sell that for liquidity, that option is also available in the financial market itself, which is known as exchanges of assets, purchasing and selling the existing securities. And the next part is financial asset, which is, I told you earlier, shares, debentures, treasury bill, bonds. All these are the measure or instruments of financial market. Now, moving on, the whole diagram which I told you, this is basically the whole financial market and how it operates. And banks also perform kind of a similar function, but we will not learn more about banks in this session. The name of the topic is financial markets, okay? So we will learn all this from the perspective and the point of view of financial markets itself. Now, coming on to the functions of financial market. What are the various functions of financial market? You already know things, right? You know that. From the starting of the session, all that we have covered till now is actually trying to tell you the functions of financial market. But what I'm trying to do is, I'm trying to pick all those informations that you already have and present them in front of yourself so that you know that, okay, I know all these things already. See, the very first function of your financial market is facilitation of price discovery. How? Let's try to understand that. Facilitation of price discovery basically means that financial market play a very pivot role in deciding that what will be the price of that particular security. which is in the market. How does any product decides its value? By the forces of demand and supply. All right. Demand is being created by the business entities. Supply of funds is being created by the households. Financial market is making sure that it is meeting both of these parties in a single platform. And with the forces of demand and supply, the price of the security is established. So financial market facilitates in price discovery. The next thing is mobilization of funds. Mobilization means what? If you have ever seen a documentary on World War, you must have heard this line. The Germans mobilized their army to the Western Front. What's mobilization? Mobilization basically means transfer of something from one place to another. And what's the transfer happening in this case? Funds. From what place? Household. To where? Business entities. And that's another function of financial market. So I'm telling you, all these things you already know. What I'm trying to do is presenting that in your table so that you know, okay, I know all these things already. Fine. Next function of financial market is providing liquidity to the financial assets. Liquidity. Liquidity basically means the power of conversion into cash. Let's say today I have this phone, this particular phone, okay? This particular phone only provides me liquidity if I'm able to sell this in the market. If I have no option of selling this into the market and no option of converting this into cash, then I have no liquidity. This has no liquidity for me. Similarly, for a financial asset, if it is not able to be sold in any market, then it loses the essence of liquidity. It loses the power of liquidity. Financial market provides that power, the power of liquidity. So if today I have some securities already in my Demat account and I'm in need of funds, what I can do is I can just sell those securities in the financial market, and SEBI has recently given not to T+0 settlement cycle, meaning on the same transactional date you will be giving the money back. You will be getting the money for your securities. So that is the work of your financial market, providing liquidity to the financial assets. The next thing is reducing cost of transactions. See, it's very basic point. This basically means that if you're providing a platform for the households and for the business entities, then they don't have to look forward to searching the parties who are in need of that funds or need of that securities. So for that case, because it's providing a common level playing field for every player, that reduces cost, reduces time, reduces efforts. So reducing the cost of transactions, financial market provide a common platform where the buyers and the sellers meet, and it will help in saving the effort, time and money of both the parties. Now that's the function of financial market. Was it difficult? I don't think so, because I'm telling you, you already know all these things. What I'm trying to do is putting that into the table. Okay, next point. Now let's talk about the various categories of financial markets. Like, financial market is also divided into two parts. One is your capital market, the other is your money market. The separation is done on very common basis is how long the securities are going to mature for. What's the maturity of the securities, or in how much time will provide me the funds. That decides that if you are going to invest in the capital market or you are going to invest in the money market. All right. Yeah. So capital market has two types, primary market and secondary market. I won't go deep down into this part first. I will talk about money market first. But I'll tell you, capital market has huge securities. Those securities that you listen about, like equity, debentures, which are having a maturity of more than 1 year, like 5 to 6 years or decade. Those are your capital market instruments. Okay. But we won't talk about this right now. We'll talk about money market first. So money market, on the other hand, are short-term instruments, short-term liquidity. Like you want money for a very short period of time. Like you want money just for raising funds for issuing security, issuing shares. You getting my point? For example, I'm a company. I want to issue shares in the market. Okay, I want to raise funds from the market from shares. Now, all that procedure will take me some time. Fine. So for that time being, I need some funds. Those funds can be acquired with the help of money market. I'll tell about that concept and the name of that concept again when we come across it. But now we'll talk about the classification of financial market, which is your money market. Money market is a place where short-term debts can be raised. So money market refers to the market for a short-term fund which deals in monetary assets whose period of maturity is up to 1 year. Very important thing right now. These securities, these instruments can only be matured and can have a maturity of just 1 year or less than 1 year, even 15 days as well. Okay, so it has no physical location and most of the activities are conducted over the telephone and the internet. So money market instrument does not have to have a very physical location like a BSE or NSE building. They don't require that. This type of transaction, this type of securities can be purchased or sold over a telephone call or over the internet. There is no requirement of a physical location. Fine, very important point. Next is your money market satisfies the short-term financial requirement of a business. For example, working capital requirement. You want to pay your salaries, you want to purchase raw material, small transactions. You require funds for 5 to 6 months. Money market is the best option for that. Okay. Now moving ahead, what are the features of money market? Mostly I've discussed about this. It is a short-term fund requirement, a market. They are quite expensive, guys. Remember that. Money market instruments are quite expensive as compared to capital market. You can purchase shares for even less money like 10, 100, 20, 500. Yeah, they go like that. Those are known as petty stocks. Okay, penny stocks. But you can never go for very cheap securities in the case of money market. Money market instruments are quite expensive, like 25,000, 50,000, 1 lakh rupees. Those are the prices of money market instruments. Okay. Money market instruments are highly liquid. You can sell them in the financial market like in a click. Okay, you can get the money very quickly. And because they are having a very short tenure, they are also less risky. Correct, makes sense. Like what worst can happen within a year? What worst can happen within a decade? Food of thought. So if you are thinking about a very long period of time, then it will have the element of risk. But here, because this is happening in a year, within a year, so nothing a lot can change about in a year. That's why they are less risky as compared to the capital market. I'm not saying they are not risky at all, less risky. The expected return from money market instruments is less due to their short duration that I've explained already. Rate of return is also less, risk is also less, expensive, yes, exactly. So what are the major participants of money market? Who are the regulators? Who are the participants? Who are the players of money market instruments? First of all, RBI, the apex authority is there. Commercial bank is there. Life Insurance Corporation of India, General Insurance Corporation of India, NBFC, state government, large corporate houses and mutual funds. In fact, SEBI, who is the regulator of money market, is also a participant of your money market instruments. Meaning, they either get the finances from money market, or either they raise finances from money market, or either they invest in the securities of money market, or either they regulate the money market. These are the players. All right. So major participants of money market, very important, guys, can come in the MCQs as well. That which among of the following is not a participant of money market instrument. Very important. Okay. Now let's talk about the next thing, which is money market instruments. Just give me a second, guys. All right. See, money market instruments are of this many types, which is your treasury bill, commercial paper, call money, certificate of deposit, and commercial bill. This is very important because MCQs that come in the examinations, it is a fan favorite. They usually ask questions from these topics. Okay. So first we'll talk about what is a treasury bill. See, treasury bill or T-bills, not T-Rex, but T-bills are actually the short-term borrowing instruments issued by the government of India on behalf of the RBI. Okay, very important. RBI issues this on behalf of the government of India. So, treasury bill, first thing, who is the player? Government of India. Who is issuing? RBI. On whose behalf? Government of India. So, if you want to invest money in treasury bill, you will have to go to the RBI. They will be issuing the treasury bills. Now, they are also known as zero coupon bonds. Zero coupon bonds basically means that they do not have any interest rate. Coupon basically means interest rate. So for example, if I want to invest money in the treasury bill, in the T-bills, then I will not be expecting any kind of an interest from that. Rather, I will be getting more money as compared to what my initial investment was. Example, if I am purchasing a treasury bill for rupees 90, then after, let's say 90 days, I will be getting 100 rupees. There won't be any interest, but yeah, they are issued at discount. That's why they are known as zero coupon bonds, because they do not carry any interest rate. There is no element of interest in the treasury bills. So they are issued at discount and repaid at par. I've given you an example here, you can read this out. I've given the exact example to you, that you are purchasing it for 90,000, getting 10,000 back, or 96,000, getting 1 lakh back. I think I messed it up before, but yeah, you will be getting more money than you invested into, and that difference is actually your benefit, your profit. So the most important part is, see, it is a promissory note, that's for sure, but the most important part is that it can only be available in the denominations of 25,000 and multiples, meaning the least amount of investment that you can do in a treasury bill of rupees 25,000, and if you want to do more, 25 plus 25, or 25 into 2, that is your 50,000, 75,000, 1 lakh rupees. In that multiples you will be able to invest in the treasury bills. Very important information, guys. Okay. Maturity is of rupees of 14 days to 364 days. Maturity is also very important in the examination. Maturity basically means that either you can get the money back in 14 days and max to max up to a year, like below 1 year, which is 364 days. That gives you the maturity of your treasury bills. Maturity is important, denominations is important, and your coupon rate is very important. Next is your commercial paper. See, commercial papers are basically issued by large credit-worthy companies when they want to raise funds. Okay, so they want to raise short-term funds at lower rate of interest than the market rate. So they would be issuing commercial paper, very short-term fund requirement. It is an unsecured promissory note, meaning it is not backed up by any security, unsecured, no mortgage. It is negotiable instrument, transferable by endorsement and delivery. So if today I have a commercial paper, I can endorse it to anybody else and that person will become the beneficiary of that particular security. Simple. It is sold at discount and redeemed at par, similar to your treasury bill. The original purpose of the commercial paper was to bridge finance. Now what is bridge financing? Bridge financing is actually the same thing which I discussed earlier. That if a company wants to go for an IPO, wants to issue public money with the help of shares, but before that they will have to incur a lot of preliminary expenses. For example, you know, prospectus expenses, certification, licensing, broker fees, all those things. So for that money, for raising that money, companies go for commercial paper because it is having a maturity of very less days. In fact, it is having a maturity of 15 days to 64 days. So that's the maturity period of your commercial paper. Again, short-term funds, majorly used for bridge financing, issued at discount, redeemed at par. The most important things that you have to remember from this slide. Okay. The next is your call money. Call money is basically between two different banks who want to, maintain their liquidity. So basically, call money is a method used by commercial banks to maintain their cash reserve ratio. As you already know that the RBI says that every bank should have this minimum amount of cash reserve ratio. But what say if one bank does not have that minimum ratio? Let's say I have bank A and bank B. The minimum balance that should have in both these bank accounts is, for example, 1 CR. Okay. Let's say bank A only has 90 lakh rupees that night and bank B has 120 or 1.2 CR. Alright. So what A can do is, A can lend or A can borrow some money from bank B, and only for that particular night. Bank A is confident that in the next day, I will be getting the balance amount. I would be able to maintain the balances. But tonight, that's a problem for me. So for that, B is the person who can lend the money to A bank, and these both are commercial banks, and that is why it is known as call money. So it is a short-term finance, repayable on demand. On demand, like there is no time limit. It's a demand limit. Whenever the other bank asks for the money back, the bank will have to return the money to the lending bank. Okay. Now, the interest paid on the call money is known as call rate. Very important. Call rates are really fluctuating. Always remember, they even vary from day to day and even hour to hour. Very fluctuating in nature, call rates, because these are fluctuating in nature. So they have an inverse relationship between the call rates and the short-term money market instruments. Meaning, if call money or call rate is high, then the banks will prefer not to borrow from these securities. Correct? If the call rate is very high, then because of the high rate, the demand for the call money will be less. And if the demand for the call money is less, then obviously the demand for other money market instruments will go high. So if call rate goes high, okay, the relationship between call rate and the return on other short-term investment is inverse relationship. That's exactly what's written here. Demand for call money decreases because call rate if high, then demand for call rate will become less, and it will increase the demand for other short-term instruments, so they will become cheaper in relation to call money. Clear? So if the call rate is becoming high, the demand for call money will be less. Because demand for call money is less, the demand for other short-term securities will be high, and because the demand for short-term securities is high, their price will go down. So यहाँ पर call money, call rate increases. On the other hand, the demand for other instruments or the price for other instruments, they reduces, they become cheaper. Now the next thing is that their maturity is of 1 to 15 days, as I told you earlier, that the maturity is very less. Fortnight, 1 to 15 days, even overnight, that's it. Okay. Next security or next instrument is your certification of deposit. Now, certification of deposit, on the other hand, are issued by commercial banks or developmental financial institutions to individuals or corporations. So they are issued by basically commercial banks or any kind of a developmental financial institutions. They can issue the security to any individual, any company, any corporate, anyone. It is also an unsecured negotiable instrument in bearer form. It is issued in periods of tight liquidity when the deposits by individuals and household is less but the demand for the credit is high. So whenever there is tight liquidity, there is crunch of cash in the market. At that time, if you want to raise money, then certificate of deposit is a very good option. So you should understand that when these securities are being issued, call money कब, जब CRR maintain नहीं हो पा रहा है, ठीक है? वैसे ही certificate of deposit कब issue करेंगे, जब credit liquidity is very tough or credit is high at that time. They help to mobilize large amount of money in short period of time. Simple thing, okay? Next is your maturity, which is of 91 days to 364 days. Very important, okay? You all should know that the maturity of all these types of instruments. Next is your commercial bill, popularly known as bills of exchange. Commercial bills are basically used by two buyers or two sellers, or buyer or seller. For example, I purchase some goods on credit from Mr. B. Let's say that this is Mr. A, this is Mr. B. B is buyer, A is seller. Alright. Let's say that A sold goods to B and in return B gave a commercial bill or a bill of exchange, okay, to A, saying that I am not able to pay you the money back right now, but take this commercial bill or bill of exchange, and after 3 months or after 4 months, I will be able to give you the money back. Let's say that A cannot wait for 3 months. So, after the first month only, A went to the bank and said, see, this is the bill of exchange which B gave to me. I am giving it to you. You give me the money back, and when B would be paying the money back, he will directly come to you and pay you the money. So that's how basically the commercial bill or bills of exchange actually work. So they also work for a very short term, like 1 month, 2 months, 3 months. That's basically the maturity of the commercial bills. Okay. Now, once this bill is actually circulated or discounted, this procedure is known as discounting of bill. When the person holding the bill goes to the bank and says that take the bill and in return give me the money. The bank charges some fees for that, but yeah, money is being received by the party. Then this is known as this becomes an instrument of money market, and it is known as a trade bill after it becomes the instrument of money market. The maturity is of 90 days usually. All right. So with that, we are done with today's session, which was concentrating about what is the financial market, how does the financial market basically operates, what are the functions of financial market, participants of financial market, types of financial market. Then we talked about the instruments of money market. All right. Now, depending on and based on these things, let's answer a few questions. For example, the regulatory body of securities market in the United States is. In the United States, what is the regulatory body for securities market? For example, in India, we have SEBI, who is regulating the securities market. Who is doing the same thing for USA? The answer is Securities and Exchange Commission. Next question is, what is the difference between a primary market and a secondary market? So, after reading all the options, you must be very much confident that option number B is the right answer. That fresh securities are issued in primary market and existing in the secondary market. Third is which of the following is not typically traded in money market? T-bills are corporate bonds. No. We already studied which are the instruments of money market. It's T-bill, commercial paper, commercial bill, certificate of deposit, call money. Okay. So these are basically the instruments of money market. Now, these three questions, I guess 4 questions, 1, 2, 3, 4. You can pause the video also. I'll just give you a second, not making it difficult for you. First question, second question, third question, and fourth question. These questions are basically for your homework, and I'm expecting everyone to answer that in the comment section also. Don't keep me waiting, okay? Now, if you like the session, guys, and you want that all these subjects of finances, management, economics, and everything from phase 1 to phase 2 should be covered in the similar manner for you, then definitely you should go and enroll to our SEBI paid batch. In the SEBI paid batch, you will be provided with live classes plus concept videos. Apart from that, detailed self-study notes, current affairs capsule, mock test for phase 1 and phase 2, and descriptive test with expert evaluation. I'm telling you guys, if you are dedicatedly following and want to pursue this job, want to get this job of SEBI Grade A, then definitely you should, tighten up your laces, pull up your socks, because this is the time to initiate, not think, initiate. So you just have to enroll to the course. That's it. And then leave everything upon us. We will be providing you with every detailed courses, every detailed information on each of the topics in the examination, so that you don't feel that, okay, something is missing. Because in this particular course, nothing is missing. All the experts have already given various selections in the past, and we are planning to do that in this year itself. So are you going to join us in this journey or not? It depends solely upon you. Okay, guys. So go and download the Oliveboard app. You can get the free PDF in the app itself. So nothing to worry about that. But yes, go and enroll in the batch right away. And do not miss this golden opportunity. Alright, guys. So with that note, this was me, Divyanshu Best, your host, your mentor, and your best friend for business, for finance and management. And I will see you guys in the next session. Tab tak ke liye take care. Goodbye and Jai Hind.
The journey to crack one of India's toughest exams, the RBI Grade B, is long, one that needs perseverance and the right strategy. Hi, this is Anil. I was fortunate to be the All India Rank 1 holder in RBI exam back in 2018. If you are aiming to crack this exam in 2024, I might be able to help you achieve this dream. As a super mentor for the RBI program on Oliveboard, I'm available to interact one-on-one with you, share strategy lessons, and draw insights from my own preparation and set you up for success. Click the link below to check out the details. See you on Oliveboard soon.